Let me introduce you this wonderful panelist. I will start with Francis Malige from the EBRD, who is leading all the financial institutions across many continents, basically. So this is the guy you need to speak with in terms of financial institutions. And then you have Benya Gebrieski, who is leading telco and heavy industry in terms of with Africa Finance Corporations. And then you have Andrew Brown, the Chief Investment Officer for BII. Okay. So welcome.
Thank you.
Yeah, sure. So today, the topic here, we will talk about like development finance, how this topic is a bit of a contentious field. On one hand, it promises like economic growth, and the other side, we see it like full of cycle of dependency, basically. In 2009, we have Baroness, he was here in Oxford, Dambisa Moyo, who wrote in Dead End about the end of it. And a few years later, in 2025 now, we have the President Trump who just stopping some U.S. foreign assistance, which is, from my perspective, my point of view, something great, which is a kind of opportunity. So my questions and the reflection, the whole reflection here is like how we as, we are in the great place of knowledge, academics, and research. How can we put emotion aside and take these opportunities as, for African nation to better shoulder real responsibility, basically, and hold government accountable for projects that rightly belong on state budget instead of, relying on external aid. That's some point of view shared by many people here and on the panel as well, I'm pretty sure. So after all, why should vital project, a vital program that serve local population be financed by, our nation from which we claim to be independence? It is a bit perplexed and it demands fresh rethinking. So luckily we have those three panelists who are well versed in Africa challenge and opportunities. So, and investment dynamic, obviously. So let's put you guys, it is the city is pretty nice, but a bit hot. The point is we want to explore how development finance might evolve from double-edged sword into a genuine driver of homegrown sustainable program. I will start with Francis. So let's just challenge a bit aid paradigm. Okay. Does development finance perpetuate a culture of dependency, or can it be reshaped to spur genuine local ownership?
So it's a very big question, and I agree that you see a lot of development finance which is thought through as in fact disguised export support. And so you say, oh, I'm going to pay for that project, but provided you take a provider that comes from my country. You see a lot of aid that is well-intentioned, but is very concessional. Our approach as EBRD is that we want to be as commercial as we can, because we think that having a commercial intervention in a country provides support. Banks need to, for example, EBRD doesn't work in Sub-Saharan Africa. Let me just start by saying this. I should have started my introduction like this. And I came here this morning and I learned a lot. We work in North Africa, and we are going to start working in 6 countries in Sub-Saharan Africa this year. So we are not going, including Nigeria, as well as Senegal, Ivory Coast, Benin, Ghana, and Kenya. And we're very pleased. But one thing I can say is that we're not going to come into any of these countries with preconceived recipes of how we are going to start working. And I think that's one of the keys for aid to not be a double-edged sword, or development finance to not be a double-edged sword, is that the country needs to decide, essentially, how we intervene. And the way we make sure that happens in EBRD is two things mainly. First is that every country we work in is a shareholder of EBRD. So we are not bringing the money from the EU into other countries. Yes, the money comes from the markets. The large shareholders are the wealthy countries, but the country is our shareholder. And that gives that country a seat at the table when the decision is made, and in fact a veto right on projects that we do in the country. So that's a very real power. Say France, which is one of our largest shareholders, cannot veto a project in Nigeria, but Nigeria can, regardless of how the respective shareholdings work. And the other way in which we do this is that when we start in a new country, we start by having a country strategy for that country, and that country strategy is agreed with the country as well. And then we believe in development finance as being as close as possible to commercial, because we believe in demonstrating and living the market economy rather than preaching it. Again, the history of EBRD, and sorry for this bit of a digression, we started in 1991 to help take Eastern Europe and the Soviet Union out of the planned economy and into a market economy. So creating an advanced market economy is the core of our DNA. And an advanced market economy is well-governed, is resilient, is competitive, is inclusive, is green, is integrated with the neighbors. All themes that we've heard are relevant this morning in the African continent. I'll remember to bring a goat next time I need to cross a border, for example, because it's going to save me a lot of time, right? So all of these themes are important to us, but then we will be working with the governments and with the private sector actors in those countries to see how we can make it work. And for example, 80% or so of what the EBRD does are private sector investments. In the financial sector is 100%. We only work with the private sector. We work with banks to provide financing to SMEs, female entrepreneurs, green pieces of equipment, and so on across our countries of operations. And so for us, it's if I don't have a client, I don't work. So it's not parachuting money into the country that matters to us. It's really finding a mutually beneficial relationship. And we were created, now you will say that's where the dilemma comes, but when the EBRD was created, we were created for a total of 7 years. Because people perhaps naively thought that after 7 years, the entire planned economy of the Soviet space was going to be forgotten, and there would be an advanced market economy in all of these countries. So you have to conclude that either our shareholders were extraordinarily naive, or we've been doing an extraordinarily lousy job, because after 30 years, we're still going at it. And in fact, we have then grown into Egypt, and we're now coming into sub-Saharan Africa, because we believe that we can contribute to creating prosperity in these countries, and we believe that the prosperity of Africa, as that was said also this morning, is a key to the stability of the 21st century. And that's why we've come here.
Can I just add something to this? I mean, so from BII's perspective, I mean, we've now been investing in Africa for 77, 78 years, so we were set up in 1948. You know, this idea of kind of, you know, whether we're creating dependency, I mean, I think a critical part of this is about working with the private sector. So we only invest in private sector businesses. We're not allowed to invest in state-owned enterprises. We don't do any sovereign lending. And for our 50th anniversary, someone decided to commission some research as to the biggest single reasons for success on the investments we'd had and the biggest single reasons for failure. And it's no surprise it was the same reason both times. It was choice of partner. And so for all of these investments that we're trying to do, that EBRD will be trying to do, kind of all of them are hugely dependent on finding the right partner on the ground and creating that partnership, because it's not It's not a development finance institution by itself that is going to make all these things happen. And so, I mean, I think that's really, the answer to whether this is a double-edged sword or whether it's working in the right way. It all hinges on that partnership and creating the right partnership.
Thank you. This is quite interesting because in terms of partnership, choosing the right partner on the ground which will defend their own interests as well, this is the key. And Bigna, you are working with the Africa Finance Corporation. How you see the development finance as a catalytic growth and work with that?
Yeah, so if I kind of step back to some of the points that were also just being made now, the Africa Finance Corporation was actually created as a project in self-help. I mean, because historically, development finance had been in its relationship to Africa has probably been seen as something led by developed countries. Looking at the lack of, say, infrastructure or financial systems and providing support. And in the African Union, the question was asked, well, why don't we create a development finance institution which is funded by African countries, staffed by African citizens, and for the purpose of serving African interests from an African perspective. So that was the birthplace. And it was Nigeria that took up the mantle and created the AFC in partnership with 7 other West African countries as the initial starting point. I mean, today we're at 45 member countries, again, all African. But the second, I don't know if the right word is innovation but principle that was embedded into the AFC, which tries to step away from this double-edged sword, it was also created as a public-private partnership. So not to create dependency from the economies on some kind of government subsidy or handout or other, whether it's coming from outside the continent or inside the continent. You didn't want to create this this issue of dependency. So I'd say approximately half, maybe slightly over half of our shareholding is private sector. And it gives a very unique DNA to how AFC operates as an organization. Yes, there are policy matters which drive our agenda, but at the end of the day, when it comes to our investment and risk-making decisions, it's really driven by a private sector commercial mentality, which we think really is the core of sustainability. When you look at the projects and the economies that we operate in.
So basically here, we move from donor recipient to more capital, more investment led, and mostly partnership. So I want to know, Andrew, how you see what is the approach you use in terms of de-risk, in terms of blended finance, in terms of the tools you use to better take advantage of that partnership with local entities.
Yeah, so I mean, I think in terms of the products that we have to play with, we invest through funds, so private equity funds or private credit funds. We invest directly into the equity of businesses, and we directly lend to businesses. I think the key part of the approach is around this whole question of the choice of partner and the level of referencing the local network that you need to have to be able to select the right partners. So we have offices on the ground across the continent. Increasingly, we're looking, every new hire is more likely to be hired in one of the markets we're investing in rather than being hired in London. So that process is ongoing because that really is the key to becoming a proper local player in the markets that we're investing in. So I'd say that's really the key element of this. If you don't know your way around a market, you will make huge mistakes, and it's very easy to make mistakes. It's very easy to pick the wrong person to work with. And so, I mean, I think that, if you're looking at kind of what's the one key thing that you need to get right, it's that.
And so if I think about EBRD, the way you are expanded were obviously in North Africa for many years now. Are you, the way you go to the sub-Saharan Africa, is it like a new model, a new methods, like constitutionalized, or it is completely just the same model you will apply there?
I think what we are going to try and do is we're going to try to use the tools we know. But the how you build with the tools you have is very dependent on the country in which you go. And so it will always be the same mindset, the mindset that you were describing as well, partnership with the clients and so on. There's a very important element there that we try to make sure that after we have worked with a partner on one theme, that remains. So a few years ago, 12 years ago, we started, for example, in Turkey, a Women in Business program, so funding for female entrepreneurs. We actually did use some grant funds because we talked to our partner banks and we realized that there was an issue. The banks told us we cannot lend to women as much as we would like because they don't have as much collateral to offer, because due to inheritance laws and so on, the men tend to get the real estate and the women tend to get other things. And so I said, hold on, all right. So we are going to put some donor money into our product so that the first loss on the loans to women is going to be paid by EBRD. So you don't have to worry about losing money through non-performing loans when you lend to female entrepreneurs. And what happened, predictably, is that Turkish banks started lending to female entrepreneurs, and then they realized a fundamental truth that I've not seen any different in any other country, is that in fact, women are better customers than men. Okay? They pay back better. And so then they said, oh, this 10% first loss cushion that you are giving us, can we please make it just 5%, but we make the loan larger, right? And if you look now, so it's 12 years after the fact, and we did a study a couple of years ago, we have stopped lending to Turkish banks for female entrepreneurs a long time ago, but they have continued doing it. Right? And so I am pretty sure that when we go into Nigeria and Ghana and Kenya and so on, we will have the conversation with partner banks about these sorts of products, and we'll see who's interested. Right? But the business model is going to be to try and stick to the difficulties of the market, try and identify where we are needed, where we are additional. Is there we heard a lot about agriculture this morning. The governor was saying that 90% of the working population in the state is active in agriculture. I believe agriculture is something that international development institutions should look at much more closely than they have in the past. And I'm sure we're going to look for ways to do it. So if you define the business model as identify market inefficiencies and try to design tools that are as close as possible to the private sector to address those, yes, that's the business model we're going to implement. But it's more of a method rather than a proper business model, in fact.
Yeah, I mean, I think that's a great illustration. I mean, I think there's an increasing trend in development finance institutions to use these blended finance models where we have access to some pools of concessional capital to try and bridge to what the commercial private sector will do. But like anything that's kind of potentially very powerful, it's also quite dangerous because unless you've really worked out how do you minimize the concessionality, how do you work out that you are backing this in a way where the concessionality reduces over time as you prove out the business case, then you're at risk. If you get those wrong, you are at risk of creating dependency because the only way to fund it going forward is with this concessional finance that's going to take the first loss. And so I think, it's an increasing trend. I mean, we've been given some small pools of capital specifically to invest in some of the most fragile states in Africa, specifically for mobilization of private capital. They're incredibly powerful in terms of what you can do with them. If you offer to take the first loss on a project, you can really stimulate activity. But we're having to be very careful and very measured about how we use that capital, because if you misprice it, if you put too much in, you're really just feather bedding the private sector.
So in terms of like taking the first loss, in that sense, the DFIs are useful for that specific model. But at the same time, how can we, in terms of the need for like infrastructure, very heavy capital demanding, and I know IFC think of those topics, but like how local financial institution can be used in that sense, and then attract more private capital, and then be more be less dependent on DFIs.
Yeah, no, sure. I mean, I think one approach that we've taken, again, focusing on it from a very commercial, private sector oriented space, because all of our funding is capital markets based. So we have the seed capital, which came from our shareholders, and everything else that we get, we borrow from the capital markets, so we have to get an economic return on all of it. So when we looked at a similar problem, which is just how do you entice a group of private sector institutions to put money into a space that they're uncomfortable with. For example, in Nigeria, we're talking about pension funds, insurance companies who have large pools of capital that regulation was introduced that said that they can, rather than just investing only in investment grade government bonds or what have you, they could start investing in up to 5% of their assets in alternative investments. So the idea being infrastructure, these other things. So even though now they had the opportunity to do it, they didn't have the comfort of they also didn't know how to do the credit analysis. There was still a lot of reticence. So us, alongside some other partners, we've seed funded a group called InfraCredit, which provides credit wraps for infrastructure projects in Nigeria. And through that, these projects have been able to raise in the local capital markets from the pension funds, insurance companies. And again, and that is not something that will go away. It'll be perpetual in the sense that the InfraCredit actually charges a commercial fee for providing that credit wrap. And I think from that first loss perspective, if they're not pricing that risk correctly, we as shareholders will have to keep pitching in. But the idea is that hopefully through trial and error that we will be pricing that correctly. The pension market will be growing their investments in that space and doing the proper credit analysis, but really kind of building up the sector from that perspective.
Basically, in terms of, it means in local currency, the way InfraCredit work, because also it depends on the local pension fund and local social security fund and stuff like that. So that's quite interesting. I think we will also, really take some questions. 2 questions, please, and please keep it very short. Present yourself, and then we can do it. So, over there, please. Thank you.
Hi, thank you for the session. My name is Shokwe Okono, and I work on the trading floor at Bank of America. I work in equities financing. My question is, do you, as development financing firms, do you have a methodical approach to what you want to solve? Is there a high-level strategy to these are the problems we want to solve now, or this is the problem we want to solve now? And for your firms, what is that problem you're focusing on right now for Africa? Yeah.
Okay. Let's take a second one over there.
Us now?
Yes.
Afternoon, everyone. Wonderful conversation. Thanks ever so much. I was going to just ask Andrew Brown. I know you're building out your teams on the continent to be more local. I just want to get an idea of where you are with that. What proportion of your teams are actually on the continent and giving you the insights you need at this point in time?
Thank you. You can take a third one right here.
My name is Sonny Roche. I'm doing AI here at Side Business School. To Begna, good news that you're looking at the pension funds that have huge huge capital, but the only problem that they seem to have is credit analysis. In this day, no, sir. AI would sort it out for them. They don't need credit analysts. My background is investment banking, and you know when you can fund a project that will pay back from the cash flow generated from the business. It can be done. I'm glad you've raised the issue here. I'm a member of Nigeria's National AI Strategy Committee. When I go back next month to Nigeria, I'll push it. I will not quote you, but I'll push it. Thank you.
Thank you. Okay. Over there, yes. Good. 64 question.
My name is Blessing Abeng, and I am focused on branding and communications, but with specific focus on helping VCs and governments reframe their narratives, especially to attract funding from global investors for Africa. And one of the challenges has always been that with DFIs, for example, you'll find VCs who are doing the best work that they can and doing the groundwork, but they can't seem to get money from DFIs because of the long bureaucratic processes and some of the things that apply to foreign VCs may not necessarily apply in an African context. So how are we adjusting those processes to make room for African VCs? But even more, what is it that you want to see from African VCs who have been doing the groundwork for years to be great partners for you?
Thank you. That's quite a diversified in terms of question. So I will start with Big now on like the development finance strategy, how we see that as a useful tool and.
Yeah, no, sure. I mean, the way we define our kind of core mandate is infrastructure development. So we classify that as power, transport, heavy industry, natural resource development, and our estimate is that it's a $100 billion per year problem to get the African continent to the same like living standards that you would see in more developed countries. So again, it's a bit vague. It's very big. It's more than we can handle. I mean, I think from year to year, we're always looking at shifts in the strategy to focus on specific segments of that. So for right now, particularly on the infrastructure side, the concept is around resilient infrastructure to deal with climate change. So not just building roads, airports, and ports, but building ones that can survive what the world's going to look like 20, 30 years from now, because that's how long the infrastructure lasts. The other one is around energy transition. So I mean, one of the things that we're always wrestling with, with a lot of other DFIs, they're choosing, okay, we will only fund green technology. And I mean, I think for us, we don't have the luxury of taking that position because we think our development mandate is as critical as fighting climate change. So yes, we do focus on green technology, renewable energy, and especially energy transition technology. But we also do fund some industries that have carbon emitting aspects to them. But our focus then is how do we do it to get the most bang for the buck, in the sense that the most lifestyle living standard improvement, the most GDP improvement per unit of, say, carbon produced relative to how developed countries got to the living standards that they enjoy today. So those are kind of where we focus our energies here. How do we build resilient infrastructure? How do we support renewable and climate-friendly technology? But then also, how do we make sure that ultimately development is the reason that we exist?
So, Francis, I mean, you have a question for like the bureaucracy and like the.
Why do you ask me?
You are French.
Very good. That's a very good answer. Very good answer. So no, look, thank you for keep asking that question, because the bureaucracy is not getting any easier in the DFIs, and I think we need to be reminded time and again that we're not quick enough. This being said, in our original region of operations, we're still the largest LP in the private equity industry in the whole region. So somehow we find a few private equity funds that actually work with us. The other thing I'd like to add to this is a repeat game. So the first time establishing a relationship with a DFI is always more painful and longer. And then the second fund that you raise, or the second time that you want to borrow from them, and so on. I mean, you can do these things in a matter of just a few months. I mean, in some cases, we've done deals in a few weeks. So I'm not saying we're fast, certainly not by private sector standards, but we're making every effort. And thank you for the reminder. There was a question on how we choose essentially our priorities. The way we do it, we have a very, very simple common sense set of questions at EBRD when we want to choose a priority. The first question is there a need in a country to do a certain thing? I've seen so many people go into a country, and because they know to do something, they invent that there's a need in that geography, right? So that's not how we do it. Is there a need in that country? The second question is there actually a champion in the country? We don't achieve anything on our own. We achieve things in partnership with the governor, with the minister, with the regulator. I could go and transform the banking sector law in all of my countries if I wanted to, but I only do it when the regulator for the banking sector says, I really want to change my banking law. Can you help me? Then yes. And then the third question we ask is that also something that the EBRD knows how to do? Because we don't know everything. We are good in certain sectors. We are not present in other sectors. So if someone asks us, for example, to transform the education strategy of a country, we'll say, sorry, that's not what we know how to do. We can help you have talk to the World Bank or talk to other people, but that's not a sector that we can intervene in. So we have, and when you're at the intersection of these three things, is when we have the most impact.
The question on the pension fund, and maybe I will even add the diaspora bond and those kind of tools. What do you think about it, Andrew?
Yeah, so, well, look, maybe just briefly to give you BII's in terms of how we look at these things. I mean, we measure every investment on three criteria around productivity. Does it make the country more productive? Sustainability, is it helping to tackle the climate crisis? And inclusion, is it reaching people who are previously excluded from access to goods and services? And so, you don't need to try and do everything with every deal. We'd actually much rather have transactions that score very highly on one of those dimensions to really move the needle. But those are the three criteria, and we say we score every transaction so we can really work out. So we score it before we make the investment, and 2 years afterwards we go back and check where are we against what we'd expected in terms of the impact to see if we've actually delivered what we said we would deliver. The other thing, I think, which is becoming an increasingly important theme for all DFIs, and the scarcer access to capital becomes, the more important it is that we play our part in terms of mobilizing private sector capital. And so I think that mobilization agenda and how we really actually do things that really catalyze private sector capital coming into our markets is becoming increasingly critical. And so again, in the last year or two, we've started selling fund participations into the secondary market in order to bring private sector investors into the African funds market. We've syndicated equity deals. We're starting to syndicate some of our debt. And again, you need to be able to make your balance sheet stretch further if you want to do more in a time when access to public capital is constrained. The other questions, the question about the team, I mean, I think it highlights, if I look at our two main geographies, we invest in South Asia and we invest in Africa. In South Asia, we've got a fully functioning, entirely independent investment team in India. We've got about 60 people. It's very difficult to replicate that in Africa because where do you put them? If you put an entire team in Johannesburg, are you really much better off than being in London? So then you say, okay, well, look, we've got regional hub offices. So we have offices in Johannesburg, in Nairobi, in Lagos, in Cairo. We have an office in Ghana as well. And then you need to start to try and build up the teams from there based on what the investment need is. So probably we've got more infrastructure team members down in South Africa. We've got our funds team spread across all of those offices. The venture capital team is putting people in Lagos and Cairo. So it's trying to say, well, what's the need and what investment professionals do we put on the ground to have the most effect? But it's complicated. You're trying to invest across 50 plus countries. They've got very different dynamics, different needs. So there isn't a simple solution. I mean, in my previous life, I was CIO of a Pan-African PE firm. We had exactly the same problem. We had 6 offices. Where do you put people to be most effective? How can you move people, particularly across the language barriers that exist across the continent? And then there was a question about the VC. Look, I think it's something we're very alive to, there is, particularly in the VC world, there are kind of fund managers who've got the knack of talking to DFIs, and there are the funds that are best plugged in their local ecosystems. So we have, to be honest, tended to we've not invested in private equity funds that are setting up venture arms. There's an increasing trend, but we've tended not to go into those. And particularly at the sort of really early stage, the sort of seed stage, we've tried to find a single country fund that really just knows its way around that market. It's very difficult to claim in any credible way to be a Pan-African seed stage manager. So, I mean, that is where we're trying to direct our capital. And, we are looking at a specific program we're launching at the moment to try and anchor smaller funds, $20 million, $30 million funds, to bring some technical assistance, because we do come with a lot of baggage as a DFI. We come with a lot of requirements. That's because those are the requirements that are put on us by our shareholders. So we know it can be a lot, and we can try and work on it. But certainly in terms of what we're investing in, we are trying to get to those smaller funds in the venture space, particularly in the very early stages.
You asked about the EBRD, but we will have an office in every single country where we operate. That's the way we've been working for the past 30 years, and it's served us well to have specialists when we can have them on the ground, we do, but to at least have a head of office and a number of people in each country. And for example, in Cairo, which is the largest office we currently have on the African continent, there's around 80 staff working on the Egyptian economy. And I wouldn't be surprised if in 5 to 10 years' time, you go to Lagos and you'll find a similar size EBRD office.
Francis. Begna, you know...
With Begna away, because he has a call. Thank you so much. Sorry for the interruption. Thank you so much, Begna. Thank you.
So, in final words, basically, we have like profitability, which is the main word here in terms of allocentrism in capital market, how we work together collaboratively and make sure at the end we come with more ownership and partnership in the countries. And in this, we are in the Nelson Mandela, lecture theater here. So I want to finish with a quote from him. Sometimes it follow upon a generation to be great. So we can be that great generation. So let your greatness blossom. Here we are here in this, big university where bright ideas coming up. So thank you for bringing that in terms of questions, in terms of, participation. So let's make, the development finance work for Africa by African as well. Thank you. Thank you. Thank you to you.